Hello everyone and welcome to the YouTube channel of Being ACCA. This is Tushita Gupta, ACCA affiliate, and in this video, I'm going to try to simplify a complex concept for you. So students usually find, the concept of forward contracts difficult. So first, we'll quickly go through the characteristics and understand the concept of a, forward contract, and then we're also trying to, understand how the numericals work. So if you have a problem understanding this concept, then try to stay till the end of this video. And I hope that I'll be able to help you with, your queries, and you'll be able to solve questions from now on. So let's get started. First, I'm quickly going to, briefly cover the concept of a forward contract. So if you talk about a forward contract, basically what really is a forward contract is that it is a legally binding agreement. Number one thing is that it is a legally binding agreement. Now, what do you mean by something being legally binding? Legally binding means that no matter what happens, you have entered into an agreement where you have decided to do something in the future. So no matter what happens in the future, you have to, fulfill what your promise was made. So today, if you're promising to do something in the future, then once that date has actually arrived in the future, you're promising that you have to do that thing which you have made a promise for. So this is what you mean a legally binding agreement. Basically, if you do not do the thing which you had promised, then the person who had gotten into an agreement, who was the counterparty in your contract, can drag you to the court that this person had this arrangement with me and now he is not fulfilling the arrangement. This is what you mean by a legally binding agreement. Now let's move to other characteristics. So it is an agreement to do what? It will be to buy or sell. So either you will buy something or you will sell something. Now, what exactly are you going to buy or sell? It's going to be a specified quantity. It's going to be of a specified currency. We are specifically talking about foreign exchange forward contracts here. So, of a specified currency. And then on an agreed future date. Now, this future date is also called your delivery date. Why? Because it is on this date that the actual delivery of, depending upon whether you have bought or sold any currency, the delivery is going to be happening on this future date. That is why it is called as the delivery date. And one more thing last, which is specified at a fixed exchange rate. At a fixed exchange rate. Now, this exchange rate which you have fixed is something which you have decided today. If let's suppose we are entering into an agreement of dollars and rupees, and $1 is going to give you to buy $1. Let's suppose I have to pay 84 rupees. Then this is the rate which we have locked today. No matter what the rate becomes 3 months, 6 months from now, or the rate at our delivery date, no matter what the rate is on that date, this is the rate at which we are going to deal the transaction in. So these are basically the characteristics of your forwards contract. Now, let's talk about it in a little bit more detail. So basically, these forward contracts are not traded on the market. So these are not traded on the market. What happens is these are custom made. What happens that, let's suppose, these arrangements are basically only made for those companies who need it. So basically, this is something of a custom arrangement. It is made specifically for you. So hence there is no trading for it in the market because you wanted this. This has been made specifically for you. Hence these arrangements these forward contracts cannot be traded in the market. Now, let's also discuss regarding a few more things. So basically, these agreements are not bought; these are entered into. These are not bought; these are entered into. Now again, because these are not traded in the market, you cannot buy an arrangement, you cannot buy a forward contract, you can only enter into an agreement, which is a forward contract. Now let's also discuss a few more things. Now, if you have heard about, hedging, so basically when you're setting futures contracts, with futures, you're also supposed to maintain margins. But over here in a forward contract, you're not supposed to maintain any sort of margin. And then if I talk about options, so basically whenever you're entering into an options agreement, there's a premium which you have to pay. But over here, there is no premium also. There may be some sort of an arrangement fee which you have to pay. So over here, the cost is nothing but the arrangement fees. Whoever you're entering into this agreement with, the person can charge you an arrangement fees for the same. So this is what the characteristics primarily look like. Now if we briefly go over a little bit of a disadvantage that we have with this sort of a thing, is that no matter if the thing has become in my favor, let's suppose I had promised to buy dollars, let's suppose $500 at a price of 84. Now let's suppose my currency has appreciated. Now instead of having to pay 84 rupees to get a dollar, now the exchange rate has become, let's suppose, 80 for $1. So even though this rate has come into my favor, now I have to pay lesser money to buy $500. Because I have entered into this agreement, I have to fulfill it no matter what happens. So on the delivery date, I need to use this entire exchange rate for the fixed quantity that we have agreed of. So this is the thing which I absolutely have to do. There is no default that I can do. So this is a bit of a disadvantage. And why is that? Because if you consider other options, for example, instruments like getting into options, basically there you have an option that you do not want to fulfill the contract. So because you have purchased an options agreement, then it's not a mandate for you that you absolutely have to execute it. You have the option to let your option lapse. So this is one disadvantage which is there with this method of forward contracts. Now briefly, we have gone through the concept and understood the basics of what a forward contract looks like. Now let us navigate to the study hub where we have an example. Let's try to work out the numbers. Let's first try to understand how the numbers work, and then we'll also try to solve the same. All right, so here's the numerical through which we will try to understand how the numerical solving of forwards works. So basically, you see the date that today is 1st January 20X1. There's a UK-based company who's expecting to receive a dividend income of $200,000. Now, I am a company, I am based in UK. So the currency which I operate with is the Great Britain pound, which is GBP. And there's this income that I'm due to receive in US dollars. So the US dollars, when they come to me, are of no use to me, because when I live in the UK, I want in my hand GBP to spend, because that's the currency that is being used in the country where I live in. So this is number one thing over here. Now they are going to receive it on 31st March 20X1. So that's roughly 3 months from now. So there are a different, plethora of rates which are given to us. So you have the spot rates given, you have the 3-month forward given, and then you have the requirements basically. So before we get on to even seeing what the rates look like, first, there are two very basic fundamental things which it is very important to understand before you try to solve any numerical. So number one thing is, the students often get confused that do we need to multiply this or do we need to divide this to arrive at the answer. So even if you're not able to remember what exactly you have to do, try to think of it in this manner. So over here, you can see that dollar per pound, you're getting 1.5. So basically for for 1 pound that you give, you're getting more dollars. So basically in dollars, it's going to be a bigger amount, and when you convert it into Great Britain pound, it has to be a smaller amount. So if you have to reach to a smaller amount, you actually divide it, you put something in the denominator so that the value which you presently have becomes a smaller amount. Considering a vice versa scenario where you want to make this thing into something bigger, then you multiply that thing. So let's suppose if the tables were turned around, there was dollar in your numerator and pound, sorry, dollar in your denominator and pound in your numerator, then you would have multiplied with the same, because then each, with each dollar that you gave, you were getting more pounds. But now coming back to the scenario where we are, for 1 pound that you give, you're going to get more than $1. So that means pound is more valuable. If you exchange $200,000, you're going to get lesser pounds. So that that gives you the assurity that you have to divide over here. You will not multiply. Now with this, we are sorted with the first thing. Now the second thing that we need to get sorted with is which rate should we use. So to decide which rate should be used, you always have to remember only one thing, that the dealer will always take the advantage. Whenever there are two rates quoted, whichever is more profitable to the dealer, that rate is going to be used in your transaction. So this is the thumb rule which you have to remember if you want to solve the questions pertaining to forward exchange correctly. So now I am also opening an Excel sheet over here so that you're able to simultaneously see the question as well as the, we have an Excel to solve the numbers. All right. So I've opened an Excel over here, and we are basically wanting to exchange USD. We will get USD worth 200,000. So basically we are getting 200,000 USD, right? And I want to convert this to GBP. Now, the first requirement says calculate how much sterling will be received if a forward cover is taken out. So that means we use the 3-month forward exchange rates. Now, these are the two rates which are available. If you're not sure which rate you should be using, simply calculate using both of the answer. And when you're considering a receipt, when you are getting money from the dealer is always going to give you lesser amount of money. So the thumb rule basically is, if you're dividing, you will divide it by a higher value so that the receipt is a lesser value, because whenever something is in denominator and that value is higher, your ultimate answer is a reduced value. So even if you want to calculate it through both of the rates and then you see whichever is lower, that is also fine. But conceptually, this is the thing, that the dealer is always going to take an advantage. He's going to have to give you lesser pounds in the scenario where you use a higher rate, which is 1.5459. So let us see and calculate the receipt in both of the cases. So if this is my US dollar receipt and the conversion rate, let me try both of the rates. This is 1.5323, and another rate which is quoted by the dealer is 1.5459. So these are the two rates. Now the dealer either can give you 130 or he can give you 129. So obviously, because I've told you that it's a thumb rule that the dealer always takes advantage. So dealer is always going to apply that rate on your transaction with which he has to give you lesser money. So either he can give you 130 or he can give you 129. So 129 is what he will give you. This is what your receipt will look like. Let us also cross check our answer whether we are correct or not. So this over here is exactly what we have worked out, 129,374. All right, now let us move to part B. This was part A. Now talking about part B. Part B essentially says calculate how much sterling would be received if no forward cover is taken out and the actual spot rate on your transaction date. So basically this $200,000 of dividend you are getting on 31st March. So if you have not taken a forward agreement, if you did not get into any such agreement, what is the rate at which you're going to convert, and how much will be your receipt? So again, over here, your receipt is in terms of American dollars is the same. This is your receipt in USD. Now, if you talk about the receipt over here, basically, again, there are two rates which are quoted. Now, like I told you, dealer always takes advantage. So it's going to be the higher rate, which is 1.5361, which the dealer will levy on your transaction. Even if you want to do it with both of the rates, that also is fine. So I'll show you using both of the rates. 1.5247 is the first rate. Second rate is 1.5361. So obviously dealer wants to give you lesser money. So lesser money is second option. So you erase this one and this becomes your receipt after. So when you go out, this money comes to you at 31st March. Then you on 31st March itself, you're going to a dealer to get this money converted. So that is when you're getting, 130 and roughly 1,30,000 is what you're getting in your receipt if you do not take any forward. So this is what calculations look like when it comes to a forward contract. Do let me know if you want me to also make a video explaining other numerical things. So if you just read this exam advice, it tells you that the calculations will only be asked for forwards and money market hedges. So if you talk about derivatives like options, futures, and swaps, for these instruments, calculations will not be asked. So I have explained forwards contracts over here, and you can let me know if you want me to also make a video explaining money market hedges. I hope that this video was useful. Thank you so much for watching.